Hello and welcome to this quick little tutorial about how to look at or learn to read your financial statements for your business. The basic ones we're going to go over on this video, just your balance sheet and your profit and loss. There are plenty other reports to look at, and you probably should be looking at them depending on what type of business you have and how you run that business. But every business, no matter what, has a balance sheet and a profit and loss. Those are the basics. And I'm just going to go over a few highlights and hope to give you a greater sense of learning of what these are and how they work together. So while these are two completely separate reports and have two very different important jobs in your business, they do have a relationship. One feeds off the other, and I'm hoping I can touch on that in this video. So I do like to start with the balance sheet, and that's simply because it is the spine or the backbone of your entire business. The strength of your business is based off the strength of your balance sheet. So that's why it's so important. I do like to kind of start there until we move into the profit and loss, also called an income statement, which is more of the story of what happened. So for the balance sheet, it is basically a report of assets and liabilities. And what does that mean? Really, just that. Your assets are the good things, the things that you own, the things that you have, things that have value. And the liabilities are, well, this is who you owe. So very simply, assets, the top of the balance sheet is almost always going to be your bank accounts. That's also considered cash. I know some people, when you say cash, you actually think of, dollar bills, $100 bills, maybe stacked up on your desk. That is cash. But in business terms, cash is actual liquid. It's money in your bank that you have access to. So in this is a completely fictional business, Craig's Design and Landscaping Services, very fictional. QuickBooks actually gives you this as a training tool, so I don't know who Craig is or even if he exists. But on Craig's balance sheet, the total bank accounts are $2,000 is what he has in cash. So that's his checking account, and he has some money in savings. And then the next most important asset, I would say, is your accounts receivable, if you have that, which means that you give terms to your customers. You invoice them, and then you give them time to pay you. Whether that time is an hour or a day or a week or a month, that's completely up to you. But it just means that you create an invoice, and that invoice has yet to be paid. Here's what's really important to know about accounts receivable, especially in your accounting, your day-to-day bookkeeping. You want to always make sure that is accurate. It's important for so many reasons, but the first reason is really because when you're looking at your balance sheet and you're looking at your assets, right after the actual balances in your bank accounts is, hey, I have $5,281 owed to me. I mean, do you really? Will you be able to collect on that? You want to know that answer. So you want to know that that is real. And the reason why I bring this up is because we see so many clients when they come on board with books that have been done by themselves or somebody else, where the accounts receivable is just not accurate. There's some old stuff from maybe, 5, 6, 7 years ago sitting there. And, oh, I'm just not going to bother with it. You want to bother with it. You want to make sure it's accurate, because you want to know, if you're Craig and you're looking at this balance sheet, that while you may only have $2,000 in the bank right now, you have $5,000 that's about to come in, hopefully very soon, or you should go out and collect it. Really, you should have just a better system of collecting payment and making sure you're getting that money right away. You should never have to wait to be paid. So just make sure that's accurate. In QuickBooks, there's a few different ways to look at it. The quickest one I find is called the AR Aging Summary. So it has a list. Here are all the people and businesses that actually owe Craig money, and here's how long it's taking them to pay. Like Red Rock Diner, they owe an invoice from almost 90 days out, somewhere within that date range. But then they also have a current invoice. I mean, this story is telling me that why on earth did you do more work for them when they haven't even paid you? That's just one example. There are lots of reasons why you want to always be looking at your accounts receivable if you have that, and make sure it's always 100% accurate. Then we move down to the other assets. So after the main assets, which is cash in the bank, money in the bank, and your accounts receivable that you can collect on, other assets. So here's an inventory asset. You're not going to see that very much. I'm not even going to bother to talk about it. That's just if you're selling things that you inventory. That's for another day. And your undeposited funds, this is a QuickBooks function. I think other accounting softwares use it as well. And that basically is like a stack of cash or checks on your desk. That's money that you've collected. You just haven't brought it to the bank yet. So again, this is a really good amount, assuming it's accurate. You always want to accurate. This means that this money is in transit and it's about to hit your account any day now. And then under fixed assets, those are your big. So that would be if you owned a building, if you owned equipment. In this case, he owns a truck that had the original value of $13,495. So those are all the assets. So this company has $23,000 in assets. And then, of course, thus the name of the balance sheet, how were those assets paid for? That's what it's going to tell us down here. So he has a little bit of AP, accounts payable. So that's bills that you enter. Could be anything. Could be your insurance bills. Could be bills for your lawyer, your accountant, bills for your vendors that haven't been paid yet. So he owes $1,600 to his vendors. He has a credit card, just a $157 balance on a MasterCard credit card he uses for his business. Other current liabilities, these are kind of quick liabilities. A lot of times you'll see payroll taxes go through here because you might only hold them for 2 weeks or a month, worst case a quarter, and then they come out. This one has a quick loan payable, $4,000. So that might be like a small bridge loan that maybe Craig loaned the business. $4,000. It's the start of the season, but he's going to pay that back within the next 6 months. So those are quick accounts, other current liabilities. And then long-term would be bigger loans. Maybe you got the idle loan. Maybe you have a 10-year fixed loan, something like that. A line of credit might be other current liabilities because you're constantly paying. A long-term liability would be like a larger loan for a bigger period of time. Even a truck loan would go on there, or equipment loan. A big equipment would go under a long-term liability. So you take all this into account. This is how he, paid for the assets he has above. And then opening balance equity, that's just when you're bringing stuff onto a new set of books. Technically, we shouldn't even have that account, so that'll be cleaned out later. It's kind of a holding place. Retained earnings comes right off his profit and loss. We'll get to that in a minute. That's just right over from net income. And net income would be the current net income. And then you get the total, which of course will always balance that. So how did the assets get paid for? By the activity happening in the liabilities. So then finally, we're going to move over to the profit and loss. We're going to look at just this year to date for Craig. And he has in sales, $8,426 in sales. And there are different ways that you can kind of break down how you want the sales to be. It's really, there's not necessarily a right or wrong way to do that. It's kind of how you envision the business, how you see the model working is how you want to divide up your income. So he has it in design income separated out from his just landscaping services. Pest control negative, maybe he had to give a refund, products that he sells, and then other services would be this one. Then cost of goods sold. So what would go in here is a very small amount. It's possible though, because what would go in here would be the direct costs it took to support these sales. So that's what we want in cost of goods, also called in cost of service, known as cost of services. And then basically down here are your overhead expenses. It goes a little bit beyond that, but a good way to kind of think about this is all the other expenses are your business expenses, including your overhead. So he has his divided up pretty nicely. I don't usually like to see a huge laundry list right there. Usually we want to see kind of bucket accounts that we can collapse up. There's not too many here, and these are kind of main accounts. So advertising, automobile, equipment rental in his line of work, I'm sure that will always be used. Insurance, definitely. Job expenses. So that's something we'd want to see if those really belong more in cost of goods sold, or if he was purchasing things that he can use again and again and again. It doesn't necessarily tie to that amount of income. Legal and professional fees, maintenance, repair on his equipment and trucks, office supplies, of course, rent, and utilities. Those could go under occupancy. So there's a listing of all of his expenses. So then you take your gross profit minus your expenses, and he gets his net operating income. And then other expenses, miscellaneous. That could also be personal. Maybe he doesn't know what they are. Maybe his accountant put it there. But anything under here, really, we want to kind of look at and either move up here or completely move it off the profit and loss if it doesn't belong to this business. There's a place on the balance sheet for that type of activity. The only thing we want to see here is really what happened in the business. What happened in terms of sales, and what did it take you to make those sales, and what kind of overhead is this business running until you get to the bottom line of the net income. Right here, he's pretty much at break even with a $630 profit. Of course, that depends on what this miscellaneous is. So that's kind of a quick overview. It is important. It takes a lot to learn how to really navigate and understand the ins and outs of these reports, but it is really important. And if you have any questions, please feel free to reach out. Thanks so much for watching. Bye.